So I decided to ask Chat GPT, what are the dangers of whole life insurance? Now, if you've been watching my channel, you know that I've already done a Chat GPT video on the dangers of index universal life and how to start an infinite banking policy. Now, obviously, if you're looking at me right here, I don't usually have my sunglasses on, and I don't usually have a hat on. I'm kind of in a different environment. I'll let you see, this is kind of my view that I'm working from right now. I'm on my perch, sitting at a hotel. I'm in the Dominican Republic, and I'm looking for opportunities for my real estate investment fund. We're doing a bunch of stuff that we're launching. Really, really excited about what we have going on. But I just ask you to bear with me today on the sunglasses and the hat and the wind. Maybe there's a little bit of wind noise. I got the sun just blasting me in my face. It's about 6:30 in the morning right now. Sun's coming up over the horizon, and it's pretty intense here in the DR. But really, really excited to be getting into this. I'm really excited to share the dangers of whole life insurance and what ChatGPT has to say, and giving my response and giving my feedback, because I'm curious. Full transparency, I haven't watched any of this so far. I haven't read any of this feedback so far. I'm going to do this live and on the fly. So if you enjoy content like this, if you want to learn about whole life insurance or anything to do with cash value life insurance in general or financial structure, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. In this video, we are talking about the dangers of whole life insurance according to ChatGPT, and I feel like most people probably felt like I was never going to make this video. But do I like to surprise people? Now, here's the deal. I've already made the videos with the other products with IUL on the dangers of IUL. I've already done something on the positives of how to start an infinite banking policy according to ChatGPT. How that said you need to use a whole life insurance policy. And I haven't read the script of this yet because of the fact that I want to be able to be authentic. I want to be able to be real about how I come through this. So what I'm going to do in this video is very similar to what I did in the last videos. I'm going to read the script, and when I read the script, I'm going to have my editor put it in black and white so you know that's the ChatGPT component of it all. And then after each point, I'm going to give my feedback, and hopefully that feedback will give some insight. Because remember, ChatGPT, what it does is it scours the internet, it searches the internet, and it amalgamates all the information that people have created on it, and it deduces it to its simplest parts, right? To its most clean components. And so I really have no idea what to expect. One of the reasons that I've never made a video on the negatives of whole life insurance, because I feel like personally, I'm going to just tell this straight up. Personally, I believe that there are not a lot of negatives if you do it the right way. I'm sure some of the negatives that I feel that are there are going to be covered in this video, so I'm not going to get into this at this point. If the video doesn't cover what I believe are the negatives by the end, if the script from ChatGPT doesn't cover that by the end, I will be sure to go over that, to cover that in this video. I'll add on my opinion towards the end. So let's do this. Let me get into this video, and let's just read the script. Like I said, it's going to go black and white on the script, and let's go. While whole life insurance can provide certain benefits, there are several potential dangers or disadvantages associated with this type of policy. Here are some of the common concerns. Number one is cost. Whole life insurance tends to be more expensive than term insurance. Premiums for whole life policies are typically higher because they cover the insured's entire lifetime and also include an investment component. The costs can be especially burdensome for individuals who have limited financial resources or are struggling to meet other financial obligations. All right, so costs. Let's talk about this. Dangers of cost with whole life insurance are just a function of bad planning and bad agents. Can costs be burdensome? Absolutely. Costs can be burdensome with anything. If you don't plan on this around your whole financial picture, then absolutely, if you don't make sure that your cash flow is stable going into this and going into your policy, I think it can be detrimental. This is one of the things that I do with people that we work with, because we deal with a lot of people that want to like front load a policy, that people that want to maybe say, I want to dump $100,000 into a policy, or I want to dump $500,000 into a policy, whatever the number is. But what I always kind of tell people is, don't worry about the front load, because a lot of people inherit money. A lot of people maybe have poor cash flow, but they have maybe $250,000 that they inherited, or maybe they sold a business and their cash flow isn't that great anymore. So the idea of putting a bunch of money into a policy seems really good, and it could be as long as the cash flow is there. But my advice is always pick a number from a cash flow perspective that is comfortable, right? So my mindset is, I always look at it like this, is you have to, and I don't want to go too far down this road because I have a feeling something's going to get covered with the investment versus savings component later, so I'll save a little bit of this. I'm sure it's going to talk about something negative investment returns, even though I haven't read it yet. That's got to be something that's been covered in this video. But what I would say is, from a cost perspective, if you just look at the amount of money that you're saving in a savings account, let's just call it for an emergency fund, at some point in time, whether that's $100 a month, $200, $500, $1,000 a month, whatever it is, figure out that number, figure out the cash flow that you're comfortable with, and then reverse engineer it from there. Don't figure out the front load that you want to do and then maximize the premium to meet with the front load. You got to do it the other way around. Find a number that you're comfortable with on a monthly or annual basis, and then you can reverse engineer and figure out what's the most I can front load into this policy without mecking it out, and that's a good way to do it. But here's the bottom line. When you look at costs, this is just a planning thing. I think it says term insurance, whole life insurance is more expensive than term insurance. Yeah, it is, but it also solves more needs, right? Like, that's the thing that you need to understand. It's not an equal comparison. Whole life insurance is also going to give you living benefits. If you become chronically, terminally ill, it's going to give you access to that money while you're alive in case you have need for long-term care, disability, alternative medical treatments when you're, maybe if you get cancer or something of that nature. It's, to me, that sort of stuff is invaluable. Like, people that say, oh, you only need term insurance, maybe your need for insurance diminishes. Well, that's based on a poor policy design. It's based on the fact that, yeah, your need for life insurance may diminish, but your need for insurance and the benefits that a whole life insurance policy will provide for you throughout the rest of your life will never diminish. That's the bottom line. And so that's why I'm a huge believer in whole life insurance in this sense. Cost can be challenging if you don't plan properly. But what I would say is, not everybody, and this is what I would say to this point, not everybody's ready for whole life insurance. If you're in debt, if you have cash flow issues, well, then what you should do is you should go get a convertible term policy first. Now, a convertible term policy is simply a term policy that covers your insurance need. You handle all your debt, you handle all your other stuff, you get your cash flow a little bit better, and then you can convert that term policy into a banking policy, design it the right way, start your emergency fund in that account, and keep building from there, improve your financial stability, and open up opportunity for yourself. And so that is the first one is cost, and I guess that's my feedback. So let's get into the second one, which is limited flexibility. So limited flexibility. Whole life insurance is designed to be a long-term commitment. It can be challenging to modify or cancel the policy without incurring significant fees or surrender charges. This lack of flexibility can be problematic if your financial circumstances change or if you find more suitable insurance options later. All right, so limited flexibility. I get a kick out of this one all the time. A lot of people like to kind of position whole life insurance as being limited in its flexibility, but the bottom line is nothing could be further from the truth. You can design, as long as you use the right blends of paid up additions and base premium, whole life insurance policies are wildly flexible. In fact, they're almost as flexible as an index universal life insurance policy. Here's the deal, though. Where this is talking about, and I think what's going to be interesting, and I hope I don't see this, I would hope that Chat GPT would be good enough to be able to go through and research and find like the people that know how to do it right. But obviously it's focusing on base policies here, because if you get a base policy, let's just use an example. I could have a policy with a premium of $10,000 a year. And if that $10,000 a year is 100% base premium, well then, yeah, that ChatGPT is right. You are stuck on 100% base premium. That $10,000 is required. It's totally inflexible. The only way, if you have any changes in needs or needs in cash flow or ability to fund it properly, and you have to make changes, well then yeah, you may have to surrender a portion of the policy. You may have to take dividends to pay the policy premiums, if you even have enough dividends to be able to do so, depending on how long it's been since you've had the policy in force. The cash value is not going to accumulate in the same way. And so yeah, it's got really, really limited flexibility when it comes to a 100% based policy. However, if you talk to anybody that is doing 100% based policies, you need to run the other way as fast as you possibly can, because that is just horrible, horrible policy design, right? And it's one of those things that it reduces. If you do a 100% based policy, it reduces and it eliminates your flexibility. The whole goal in what we do with people is we focus on building in that flexibility, and focusing on creating an asset that will be an emergency fund, that will be an opportunity fund, and that will be flexible with you, that will grow with you. It goes back to the last one with costs. You want to make sure that you're not stretching yourself to a place of complete discomfort or complete, exposure on risk if cash flow changes. And at the same time, I could design it so that your cash flow, if you have a $10,000 premium, instead of having no flexibility and being required to pay that $10,000 premium every year, I could show it so you have a $10,000 premium, but you could reduce that premium all the way to, say, $1,200 a year. So there's wild amounts of flexibility there. And by the way, even if you couldn't come up with that $1,200 a year, now we can use policy dividends to cover the $1,200 a year. It's a lot easier to have that happen, because when you design them this way, cash accumulation happens a lot faster. The dividends will go a lot further in helping sustain the policy, and so you are not as at risk. This is why if you design a whole life insurance policy like this, like we talk about, you are able to have almost as much flexibility as an index universal life policy, and you're going to have more stability and guarantees at the same time. So one of the things that I think is important to understand is that whole life insurance is infinitely more flexible than people realize. Apparently, Chat GPT didn't figure that out. So let's keep going now. Complex policy structure. Whole life insurance policies are often complex and involve intricate financial components. The investment aspects, such as cash value accumulation and dividends, can be challenging to understand fully. It's crucial to carefully review and comprehend policy terms, including fees, interest rates, and how the cash value grows over time. All right, so yeah, I would agree. You should never put your money into anything you don't understand. That's just I think with any asset, that's the case. To that point, I would argue, how much do you understand about your mutual funds? How much do you understand about the stocks and investments that you do? Or are you just giving your money to some advisor and having them take responsibility for your financial success? It's one of the things I call with the 5 F's of life that I talk about: your faith, family, fitness, finance, and freedom. Your finance component of this, everybody knows that you can't outsource your success with your faith or your role as a husband or your fitness. Nobody's going to eat healthy for you and do your workouts for you. You got to take responsibility for all that. But with finance, somehow people have been bought into this idea that you could just give your money to somebody and they're going to take it and make you successful. One of the things I teach on this channel is that you need to be absolutely 100% accountable for your own financial success. And what does that mean? That means you need to understand the vehicles that you're putting your money into. And I think if you do your due diligence and you do your research and you really dive deep, you are going to understand exactly what you need to do to leverage life insurance to help you accomplish your financial goals. And whole life insurance can be a huge foundational asset. I'm a huge believer that a properly designed whole life insurance policy is the number one foundational asset that you should have in your life. The complex structure is what it is, right? When we look at this, I'm looking back what it says again here. The complex structure, the investment aspect, that's the other thing I would say. It's not an investment aspect. It's a savings aspect. The fact that Chat GPT is even using that languaging tells me that it doesn't really understand, or it's going to people that don't understand, because investment entails risk. Whole life insurance has guarantees. It's the more of equivalent of a savings account, not an investment account, and that's important to understand. All right, so that leads me into the fourth, danger of whole life insurance according to Chat GPT, and that is lower returns on investment. Now, I just said they're not returns on investment. You cannot look at it like that. I think looking at it like an investment, if you look at a whole life insurance policy as an investment, you're not going to understand it properly. You're not going to leverage the asset properly. and you're gonna look at it and it's gonna be pathetic. You cannot compare a life insurance policy to an investment. You have to compare a life insurance policy, a whole life insurance policy, when properly designed, to a savings account, because it's gonna have the attributes and the benefits more of a savings account than it is of an investment account, because you don't have the inherent risk inside of the policy. Now, the only thing I'll say to that is it's not for everybody, right? Because if you don't believe you need to have money in an emergency fund, if you don't believe you need money in a savings account, if you're not a real estate investor, if you're not an entrepreneur who's wanting to leverage that capital without interrupting your growth, I don't know if it's going to get into this later, so I'm not going to go too far down that rabbit hole even, but if you don't believe those things, then a whole life policy with a high cash value whole life insurance policy is probably not for you, and that's okay. But now let's get into the low returns on investment and see what it says. According to Chat GPT, the low returns on investment for whole life insurance. While whole life insurance policies include a cash value component that can grow over time, the returns on this investment portion are generally lower compared to the investment options such as stocks, bonds, or mutual funds. The policyholder may miss out on potentially higher returns by allocating a significant portion of their premiums to the insurance component rather than investing elsewhere. All right, so I guess my feedback to that is, when you look at a whole life insurance policy as an investment, as I just said before, kind of reading that section, if you compare it to stocks, bonds, mutual funds, anything of that nature, actually, I would say, what does it say here? Does it say, I'm going to go back up, stocks, bonds, and mutual funds. So here's the deal. Stocks and mutual funds, whole life insurance is going to not perform as well as, because it doesn't have the same risk profile, and that just is what it is. That's like asking a CD to compete with a bond or to compete with a stock or a mutual fund. It's just not going to happen. It's not going to win. It doesn't have the same risk profile. So to expect a whole life insurance policy to compete in that platform is just unrealistic. However, whole life insurance is a great bond alternative. I don't know who thinks that whole life insurance is not going to compete with bonds, because whole life insurance competes amazingly, wonderfully with bonds over a long period of time. And when you look at the ancillary benefits that you get with whole life insurance above and beyond the bonds, whole life insurance is going to get you right now, in today's interest rate environment, 4.5% to 5% long-term internal rate of return. Bonds are going to get you about the same, but from my understanding, bonds are not going to get you a tax-free death benefit and tax-free living benefits if you become chronically, critically, or terminally ill while you're alive, to be able to manage your medical treatments and maybe long-term care needs or disability needs or anything of that nature as you go through life, right? So it's one of the things that I believe, I always say whole life insurance is like the Swiss Army knife of the financial world, and that's why, once again, I believe it should be the financial foundation of your life. Now, if you are looking at it, comparing it to an investment, and that's something you've looked at, then I would really, really urge you to think differently, to do your due diligence, to do a much deeper dive on research, and maybe come to a different conclusion, or maybe you just, at least you make a better, more educated decision for yourself at that point in time. All right, so the next one that ChatGPT says with whole life insurance that is a negative is opportunity cost. Now, this is an interesting one for me, because opportunity cost is actually one of the things that Nelson Nash talks about in his book, Becoming Your Own Banker, as one of the things that whole life insurance can solve the most of. So I haven't read this yet, so I'm excited. I'm going to read this, and then we will see what is happening with it. All right, so according to ChatGPT, opportunity cost. By allocating a substantial portion of your premiums towards whole life insurance, you might miss out on other financial opportunities. If you have other debts, such as high interest credit card debt or student loans, it may be more beneficial to use the funds to pay those obligations off rather than investing in a whole life insurance policy. You know what? I don't disagree with this, actually. I'm surprised that it went completely that angle. From that perspective, it makes a lot of sense, actually. I am actually a believer that from this perspective, at least, opportunity cost is actually a risk. I've always kind of told people there are situations where utilizing a whole life insurance policy, when it's designed properly, can be used to help pay off your debt. In most situations, it doesn't make sense for people. If you have a lot of high interest, toxic consumer debt, like credit card debt, you want to make sure that you are paying that debt off first, getting a convertible term insurance policy, making sure your family and everything, and locking in your insurability, making sure all that is taken care of, And then after that, pay off your debts, then convert that term policy to a permanent whole life insurance policy, and you design a banking policy after that point in time. So it makes no sense when you have 20% credit card debt to go out and put a bunch of money into a whole life insurance policy where you're earning 4 or 5%. It just makes no sense. So from that perspective, I agree with Chat GPT on this with the opportunity cost, that it is too high, and you want to make sure that you clean up your financial life. That's one of the things we always talk about. We want to be as financially efficient as possible. And that goes for investments, it goes for savings. It's one of the reasons that I love whole life insurance is it's the most efficient place to save your money, not to invest your money, but save it. And so from this perspective, opportunity cost is actually really big. If you have a lot of consumer debt, if you have a lot of high interest loans, make sure that you have that taken care of before you start contributing a lot of money to whole life insurance policy. And I think this is one of the areas that a lot of agents do get it wrong. A lot of agents are trying to get people into whole life insurance as this kind of one size fits all product that will solve all your problems and handle all your issues. And the bottom line is nothing could be further from the truth. You got to be careful about this, and you got to look at everything from an airplane view and make just a well-rounded decision for your finances. And so that is opportunity cost, and I wonder what is going to be next. So, here we go. Inflation risk. All right, ChatGPT, according to ChatGPT, here's what we got for inflation risk. Over time, the death benefit provided by a whole life insurance policy may not keep pace with inflation. While the face value of a policy remains constant, the purchasing power of that benefit can diminish it over the years. It's important to consider the impact of inflation when evaluating the adequacy of the death benefit. So inflation. So this is just not accurate. So here's the deal. It goes back, if you do a 100% base policy, I don't know if you understand how this works, but if you do a 100% base policy, that would mean I would buy like a $500,000 death benefit, and I would start accumulating cash value. The death benefit would always be completely level, and so it would never increase because I'm not using paid up additions. However, if I am, and by the way, that is the wrong way to do it, but if I am using a good blend of paid up additions and base policy, what's going to happen is that $500,000 of insurance is going to constantly go up. That's going to protect me against inflation. That's going to solve that need. On the other side of it, what ChatGPT didn't talk about is the fact that inflation, how it impacts your savings. If you look at a savings account, if you believe you need an emergency fund and you have that emergency fund in a savings account, that's not going to keep up with inflation. You're going to lose money to inflation, the purchasing power. Just in the last couple of years, we've experienced this environment where what can happen, right? At the end of the day, listen, if we hit inflation rates at 8%, everybody's going to have a hard time keeping up with inflation on a year in, year out basis. Over time, obviously, we can look back to 1971. From 1971 to today, average rate of inflation is just over 4%. And so it is what it is. Like, inflation is higher than the Fed target rate that they're going after. I mean, their target rate is 2%. The average rate has been 4%. So I think we need to look at that 4% number. The average returns for a savings account are about 0.5% over that time. The average returns, like a real internal rate of returns, net of all fees inside of a whole life insurance policy since that point in time, are just north of 5%, right? So it's about 10 times of a return you're going to get in your insurance policy compared to a savings account historically over a long period of time. Now, year in, year out, nobody really knows what's going to happen. We can't solve long-term problems with short-term thinking. We have to be thinking about the long term here. And that's why when we look at inflation, if you design the policy right, use the right blend of paid up additions compared to the base policy, your insurance, the death benefit is going to increase over time. It's going to solve that inflation need there. It's going to make sure your death benefit is increasing with inflation. And then from a cash value accumulation perspective, from an emergency fund, from a liquidity perspective, the cash value is going to grow faster than your savings account. So where this ChatGPT says that inflation is actually a danger of whole life insurance, I would say that whole life insurance is actually a solve for the inflation risk that you have in these other areas of your life. All right, so the next danger, according to ChatGPT, is the potential for policy lapse. If you encounter financial difficulties or fail to pay the premiums consistently, there is a risk of policy lapse. If the policy lapses, you may lose coverage and accumulated cash value, which can be significant, which can be a significant financial setback. So, yes, policy lapse is a big thing. This is absolutely a risk if you design the policy improperly. This is one of the areas where you want to make sure you're working with somebody who really, really understands how to do this, who understands how to do the right blends, who understands how to design the policy to meet your needs, your goals, your objectives, your cash flow, that really can work with you and be there with you. Because what I've seen more often than not with people that run into policy lapse issues is they just don't understand what they're involved in, right? This goes back to, you should never put your money into anything you don't understand. And this is why I think the people that we deal with, it's easier to sell one of these policies to somebody who's really successful, because they understand the principles of the financial principles of success, and so they get it. And there's not a lot of convincing that goes into it. And they're in a situation where they don't have to worry about policy lapse, right? Even if you're a lower income, and once you get your debt, maybe you're middle class, kind of like, let's call it 50 to 100K a year of income, even if that's you can, this is still a really, really good strategy for you for your safe money. Should you be putting everything that you have into it? No, you shouldn't. It should never be everything for you. I'm a big believer you need to reverse engineer every plan that you make to meet your financial goals and objectives. You got to align your money with your values and your beliefs. That's the biggest problem. That's one of the reasons that I think more people are failing in this world, struggling with their money is not in alignment with their values and their beliefs, period. And I truly, truly believe that if people understand how to do this whole life insurance thing, and they understand the role that it can be as a foundational asset, not an investment, but an asset that is a savings alternative that solves many, many needs for you, then you can, just really accelerate. You got the curve, the growth curve of you reaching your financial goals. It's like that hockey stick effect. It goes slow at first, but you got to be willing to go slow to then go fast. And that's just kind of a principle of success when it comes to this stuff. But when it comes to the lapsing side of it, what I would say is, you need to make sure that you're not stretching yourself too thin. You need to make sure that that you understand life happens, and that whatever policy premium that you come up with, you're comfortable with, even if times go bad, even if you lose your job, even if maybe cash flow dries up for some reason. I mean, there's a lot of uncertainty in the world right now, so you got to make sure that you are prepared for whatever comes at you. And so you got to design that policy to be able to meet all of the different things that could, all the different scenarios that could happen and meet you in your life. And that's one of the reasons that you got to work with somebody that really, really understands this stuff. I've literally done probably close to 1,000 of these policies and helped agents and helped people with nearly 1,000 of these policies at this point in time, maybe more. And I've yet to run into a policy lapse issue personally. Policy lapse issues always come down to poor planning, always come down to a massive lack of understanding. And I would just say, if you don't understand what you're getting involved with, well, then you shouldn't be putting your money into it in the first place. And if you're confused about it, well, then watch more videos, take more time, learn more. And if you can't get to the place where you're comfortable with it, then just don't do it. Like, I don't know what else to say to that. But all I can do is speak from the terms of, like, what would I do if I were you? And it's like, I would learn more and I would get comfortable, or I would try to learn more. And if I can't get comfortable, I just wouldn't do it, right? So, like, that's what I encourage you to do. So, all right, here we go. Those are the dangers. So let's see how it ends off here. This is the conclusion of this. It's essential to carefully assess your financial goals and circumstances before committing to a whole life insurance policy. Consider consulting with a financial advisor or insurance professional to thoroughly understand the risks, costs, and potential benefits associated with this type of insurance. Ironically, it's telling you to go talk to an insurance agent, but the bottom line is 95 to 98% of insurance agents don't even understand. You could go talk to 95% of insurance agents out there, and they're still not going to be able to guide you. And I think that's one of the dangers here, right? Is, like, unfortunately, there's so much bad information out there. There's so many agents that just don't even understand. And sadly, the life insurance companies themselves, the companies that engineer these products, there's more profitability in them to sell all the base policies. And so the training from a top-down perspective doesn't really teach people, agents, how to sell these properly. That's one of the passions that I have for this industry. That's one of the passions that I have for creating all the content that I create, is to educate agents how to do this better. That's why I launched the IMO that we have, because I believe that agents should be educated on how to do this, because it's about serving people. And once again, I truly believe a properly designed whole life insurance policy can be one of the most powerful financial assets. It should be the foundational core to your financial life. And when you run that around it, it becomes a filter. If you run your finances through a whole life policy, it becomes a filter on how you make your investments. It is not your investment. Now, I always call whole life insurance is the BASF of the financial world. I don't know if you remember the BASF commercials from like when I was watching NFL in the 90s, you know, as a kid growing up in the 80s and the 90s. It was like BASF, their tagline was always like, at BASF, we don't make the products you buy, we make the products you buy better. So whole life insurance is not the investment we make, right? It makes the investments we make better, because you build that financial foundation, you have your emergency fund, you make sure your financial foundation is solid with safe, guaranteed, accessible capital. It has all your other needs. It's got the life insurance, the medical stuff taken care of. It covers you in all these different areas. So then when you decide to actually go invest, you're not a speculator, you're an investor. And that's the difference between financial success and not, because we're gonna go through market cycles. It's not doing well when everybody else is doing well. A lot of people feel like they can do well, and then when the market goes down, if you're not prepared, and I think we're going to have a lot of people. Warren Buffett was interviewed back in 2010, you know, about the Great Recession, and he said, man, it's funny, when the tide was rising, when everything looked good, everybody was performing well, but the bottom line, when things got bad and the economy went down, when the tide went out, a lot of people had no bathing suits on. They were left naked and exposed. And I think a lot of people are in that situation right now, and we're going to see, I think, the tide go out right now, and a lot of people are going to be exposed. And I believe a properly designed whole life insurance policy is a way that you can build that foundation and make it so you have more security. That makes it so you're an investor and not a speculator. But you can't do it like everybody else is doing it. You got to understand the different ways of navigating, the different ways of designing the policy, and making sure it fits into your life properly, because it's not just the policy, it's how you utilize the policy that matters the most. It's how you leverage it. You got to capitalize your accounts, and then it's how you utilize it that matters the most. But as far as the dangers and the Chat GPT stuff goes, the interesting part was, now in looking back, and I'm comparing this to the dangers of the IUL, which I'll put on the end screen here if you haven't watched that one yet. I think it's a pretty accurate assessment. I think the dangers that Chat GPT said here, if you're dealing with a traditional whole life agent, are accurate. However, they're so easy to get around, and honestly, some of the dangers it said were actually really not dangers at all. Like the inflation thing, it's not a danger. It's a great hedge to inflation. It's a great way to counter that. The opportunity cost thing, yeah, the opportunity cost is there if you have the debt and you have a bad toxic situation, and I agree with that wholly. But honestly, if you look at how you can borrow against your policy and never interrupt the growth of your own money, that solves, if you utilize a whole life insurance policy properly, it solves the biggest problem in your life, which is opportunity cost. If you want to get to your financial goals faster, more predictably, with less risk, that is it. And so opportunity cost is your biggest problem, and whole life insurance helps solve that problem. So I just think, I guess I find that funny. But that's it. Hopefully you guys found value in this video. Hopefully the wind wasn't too crazy, because this is just like, I literally feel like I'm in a wind tunnel. We got a storm coming in now. It's the Caribbean. It is what it is. But if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Really excited to be here. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.